the statement of financial position for the company is as below. So we have the statement of financial position, which is summarized, and then we have. Is not sharing? Is it sharing? Okay. So this is our financial position. Then we have this information. When we are dealing with this, as we said, the required, if I check the required of this question, oof. The required is compute the cost of each source of finance before the new issue and the wachacha. Then they compute the marginal cost of capital. So now, if we go through this question, when we are dealing with this, I think if you look at our sources that we need to look at specifically, we need these two. I need this. I need these three. Now, when we are dealing with this, we first look at which one is easy to compute. I think if you look at the easiest, it is the cost of bank loan. It's the easiest to compute. So cost of each source of finance, that's the solution. Cost of each source. Now, if I look at this, as you have said, number one, it is the cost of bank loan is the easiest. Cost of bank loan, maybe we can abbreviate as KBL, cost of bank loan. Now, how do I need the first thing when you are answering this part? Please state your formula. That's the first thing. State the formula. The first thing is to state our formula. So how do I get the cost of bank loan? Since it is an floated debt, the cost of a bank loan will be the interest into 1 minus t. Then the next part, what data do I have to feed my formula? What's the data that I have to feed this formula? So if I check in the question, already we have our t, which is 30%. I have that. Then I have my I. If I check my question, I have the interest, which is 10%. It means I have all the necessary information that I can use to compute this. So simply in this case, our cost of the bank loan will be equal to, if I substitute in my formula, 0.1 into 1 minus 0.3. Make your calculator bit very fast in this. So if I substitute, in that case, I'm going to have our KBL equal to 0.07 or 0.1 times 0.7. And I think we get what? 7%. Now, that is the cost of the bank loan. Another simple to calculate in this case is the cost of preference share. So I can go to the cost of preference, cost of preference. Still, I need to state my formula. I need to state my formula, which is going to help me to get the data from the question. So what is the formula? The formula is to get the dividend, which is paid to the preference shareholders. I divide it by the current market price. Now, the next part, do I have the data to feed this? Do I have this data to feed this formula? So the data I need in this question is the dividend. Do I have the dividend? I can go up. So in the question, I was not given the dividend up, but if I go down here, information number 2, I was given the dividend which is 10%. It means my dividend will be, to get this dividend, it will be equal to the 10%, which is my dividend rate. I multiply by the par value. Maybe I can first write it will be the rate times the par value or the nominal value, which is going to be 10%. I multiply by the par value of the preference, which is 100. Please, which is 100. I think in this case, our D will be 10. Then the next part, do I have the price, my PO, is it given? So I can check again in my question whether I have the current market price for these shares. Still in the information, I was given that the current market price for the shares is 150. So I have the price, current market price. And is it CHUM? Is it, because if I check here, it is a fixed, they have not told us whether the company is as announced. So it means this is an ex-div. I have the PO, which is 150. So I can now compute my KP. Very simple. My KP will be equal to 10 divided by 150. Where we are going to get 10 divided by 150. And it's going to be 6.7%. Now, if I go to number 3, I can now compute the other easy one. I can compute the cost of irredeemable. Cost of irredeemable debt. Now, if I'm to compute the cost of irredeemable debt, which data do I need to compute this? First, I can state the formula. I can set my formula here. My cost of irredeemable debt is equal to interest into 1 minus T. Then what I get, I divide by the current price. Now, the next, do I have this data in my question that I have? Because I think one of the challenging aspects when it comes to this is to be able to get the data from the question. Do I have the data to feed this formula? So I can now check which data do I have to feed this formula. what is the data that I have? I need to get the interest. And how am I going to get the interest? It's equal to the interest rate or the coupon rate minus the nominal value. The nominal value. And our CR, if I go to the question, the coupon rate in the question is given as 14%. That's the coupon rate, and the par value is given as the par value. Let me sit down. Did I give the par value? Yeah, by giving this information, it means the par value is 1,000. So my coupon rate is 14%, and the nominal value is 1,000. So it means my I can compute it, will be equal to 14% times 1,000, which I think is equal to 140. I have that data. Then next, do I have the price in the question? The question has told us that the current market price for this irredeemable is 980. So I have the current market price for this debt. So do I have tax? Already I have it. T, I have it, which is 30%. So it means in this case, I have all the relevant information that can help me to compute the cost of this debt. So if I substitute in my formula, my
sir.
Yes, please.
Where have you got the nominal value of
So where is the value of redeemable shares?
I have not given, but I was given the market value. Remember what we talked about? The market value is 980. Automatically, this tells me this debt is currently trading at a discount. So its nominal value is 1,000.
Okay.
Yes. So if I substitute in my formula to be 140 into 1 minus 0.3 divided by 1,000.
So excuse.
Yes.
I was asking, for me, I don't see the par value of redeemable debt.
We said, if you remember when we are discussing this, because we said the nominal value, these debts are in denomination of 100 or 1,000.
Yes.
That's what we said. Even if the question has not told you, by looking at the market value, you can know. If I look at the market value, I can automatically know that the par value is this amount by looking at the nominal, the market value. Now, if you look at the market value, which is 980, automatically that tells you the face value of this debt is 1,000, but currently is trading at a discount.
So how can you know that it's trading at a discount?
Because the nominal value is 1,000.
Yet it's not the question.
It's not in the question, but looking at the market value, it tells you that automatically. Because as I said, debts are either in 100 or 1,000.
So meaning that par value cannot be below 100.
Huh?
Do you want to mean that par value cannot be?
If I have a debt of 98,
yes.
What does this one tells me? If you have a market value of 98, what will be the par value?
It's 100.
It's 100 automatically.
What I'm asking right now is that par value cannot be below 100 or below 1,000.
No, they are always in 1,000 or 100.
Okay.
Yes.
Sir.
Yes, please.
My question now: why do you use 1,000 instead of 980.
Yeah? 980 is a market value. Hey, this one is market value, sorry. Yeah. 980, sorry. So what are you getting now? Are you getting 10%? So now, if I 10%, if I go to number 4, which is the cost of common stock, which will be our KE, and we said it is D1 plus G. If we are using a dividend model, since we don't have any of the data to use, I think the only alternative is to use the dividend model in this case. Now, which data do we have to feed this formula? If we check our data, we have the D0, the current dividend the company has given. Current dividend, the company gave a current dividend of what? 35. No, it is 44. The current dividend is 44. So we have the current dividend, which is 44. We have a dividend, which we call the DN, which was given in 2015. This is 2015. Today is 2023, I think. This is 35. I have D1, I don't have it. I still have a question mark. I don't have it. P, the current price, bit. I think I may even have forgot. The current price is 240. The current price is 240. Now, what about G? I don't have it. I don't have G. So these are two items that I need to calculate. The question now, how am I going to get G? Which formula should I use? Automatically, by having the dividend in 2015 and the dividend in 2023, you are going to use arithmetic model to calculate this. You are using an arithmetic model to calculate this. So how are you going to get our G? Because we need the G now. Our G will be the So we are putting in, this is going to be how many years? 2023. Are you having it 8 years?
Yes, we take now 7th root, if I'm correct.
Are they 8? Are they 7 or 8?
We take n minus 1, so it is 7.
It is 7.
Yes.
2023 minus 2015. It is 8. 7, eh?
Yeah, it's 8 when 2015 is included, so we take 8 minus 1, which is
Okay.
7.
So 44 divided by 35. Then what we get? Minus 1. And you get what? For me, I'm seeing as if they are 8 years. Yes, please. N is 8. Yes. I'm also seeing 8, not 7. Because if you count, may I always count in a local way. If I count 2016, 2017, 2018, 2019, 2020, those are 5. Then 21, 22, 23. I think they are 8.
Yeah, it's okay. It's correct. It's 8.
Yeah.
Excuse me.
Yes.
If you are going to count for the months or years, are we starting with the year of 2015 or we start with 2016?
2016.
We don't count 2015.
No, we don't count 15 because 15 is already at the end.
Then the number we raise 1.
No, because you have already raised 1. You have already raised 15. You started with 16. And if you start with 15, then you raise 1.
Okay.
2.9%. 2.9%. 9%.
So I have G. Now, what I need now is D1. How do I get D1? From my formula, it is D0 into 1 plus G. So I can now substitute to get D1. So it's going to be D0 is 44 into 1 plus 0.029. You get what? You get
45.2.
45.2.
27.
Yeah?
27.
So I think now we have all the variables that can help us to compute our KE. So our KE will be equal to, we can substitute 45.27 plus 0.029. Then I divide it by 240. 45.27 divided by 240 plus 0.029. So that is what we have. I don't know if you are, that's what you get for this. Now, I can now go to, if you don't have a question, I can go to the cost of redeemable. That is a number 5 thing. Number 5. Cost of redeemable. Redeemable debt. And we're going to abbreviate as KRD. Now, how do I get what I need in this one? We need an IRR. So our KRD, what we need is the IRR of this debt. Now, which variables do I have to compute this? So what I need to get the NPV first. So which data do I need to get the NPV? First, I need the interest, or I have the par value or the nominal value of the debt, which is given as 1,000. I have the coupon rate of the debt. What is our coupon rate? 16%. I have the coupon rate 16%. So having a coupon rate, I can get the interest. How do I get the interest or the coupon? The interest of the coupon will be our nominal value times my coupon rate, which is going to be 1,000 times 16%. Then I adjust with the tax, which is 1 minus 0.3. I hope you remember that.
Hello?
Yes. So what we are going to get our coupon or our interest as it? What do you get? I hope that is the number. So I have now the interest. So my interest is now given. I've already calculated it. Is 112.
What is NV?
Huh? Nominal value.
Oh.
Yes. Then I have what I need is the market price, the current market price of the debt. Is it given? I can check my data. If I look at information number 4, I have the current market, which is trading at 1040. 1040. I have that data. I need a redeemable value. And they have already told us that the debt is going to be redeemed at the debt is redeemed, information number 5. No, number 4 again. We are redeeming the debt after 5 years. at a premium of 20. So I have, it means the debt is going to be redeemed at a premium. So my redeemable value will be 1,000 plus 20% times 1,000, which is equal to 1,200. My N is already given as 5 years. So I have all the data that I need now. Can I go for NPV we are going to first get the NPV at 16%. If I discount this data at 16%, what will be the value? So I have my item here. I can even start from here. I have my item. I have the period. I have the cash flow. I have the discount factor, which is at 16%. And I have my PV. Now, my first item is the market value, or the PO. My PO in this case is in period 0, and the cash flow should be negative because that's when you are investing in the debt. Now, my interest or coupon, my interest or the coupon, it's from year 1 to year 5. From year 1 to year 5, and it's going to be okay, it is 112. Then I have a redeemable value, which is in year 5. The maturity, and I've calculated as 1,200. So remember the formula we said. We said the lump sum and an annuity. If you remember what we talked about last time. So for this one, I'm using a lump sum where I will have 1 plus 0.16 power minus 0. And I'm going to copy it here down. I want to copy it here, but here I change to power minus 5. This one, it is constant from year 1 to year 5. I must use an annuity, or you can read the table because you have the table. You can read the table. 1 minus 1 plus 0.16 power minus 5 divided by 0.16. Then I can get my PV, which is this times this. I've rounded off. So my NPV will be minus. This is going to be the NPV. Minus 102. So this is the NPV at 16%. Since I have a minus, I think now I can reduce to get a positive It's a battle of reducing such that I can get a positive. So,
Excuse me.
yes, please.
Scroll up a bit.
Up to
Step. Course.
can we move on? Is it okay, mister? So we are going to reduce this one to 8% probably. You can make this 8%. So if I make that one 8%, this one will be 0.08. This will be 0.08. 0.08. This one will be 0.8. Wow. So we have the NPV at both a positive and a negative. So once I have that, a positive and a negative, I can now interpolate to get my IRR. So my IRR using our interpolation formula that we know, I can even go and copy it up. Let me copy it up. It is here. So I have this formula already. Now I can compute my IRR. So my IRR, if I substitute, my A is the lowest, as we said, it will be 224. Divided by 224. Minus become plus 102. Hope your calculator already got what you want. 0.16 minus 0.108. I'm missing one item, which is 0.08 plus now waiting for your answer. You got
13.5.
13.5%. So that is what the cost of resource that we are talking about here. I don't know if you have a question.
So I want to look at the table above.
Excuse me, sir.
Yes. This one?
Why
Yes,
did
probably.
you use?
Why do
I'm
you
asking. I thought that this A is standing for
cost of,
the cost of.
you can use any as long as you can master signs. I can start with this. There's no problem. You'll get the same answer. If I start with this, I'll have 0. If I start with that, 0.16
Yes.
plus the answer is the same. Minus 102.
2.
I divide by minus 102, isn't it?
Yes.
Minus 224. The answer will be the same. And then here I will have 0. Now be 0.8 minus 0.116. You're going to get the same answer. If I use the cost of capital, if I use the lower rate and the higher rate, it's giving me the same answer. As long as you can mark your signs. Are you not getting the same answer?
I don't have a calculator. The one who has a calculator should calculate so that we
Okay.
can avoid.
Okay, let me show you. This is 102 divided by 102. That is 326. 326.
Okay.
Isn't it? Times.
Bank statement.
Please mute. 0.8, but minus 0.08. What do you get is that? And if I get 0.16 plus this, isn't it like that? Here we had 13.5. What do you have here? It's the same. So you can use whatever it is clear for you. You can use cost of what I'm emphasizing. You should be able to know how to play with your signs.
Yes.
Yeah, you get the same answer. So now we have already got our cost of each source. What is now remaining is to get our wachacha. So what is going to be our wachacha? Now, there are different ways. Sometimes a question can ask you to get the book value, or sometimes say get the market value. But if the question is silent, compute the wachacha using the market values. If it is silent, compute your wachacha using market value. Now, what are the sources we have? Our sources of finance. We have the bank loan. I have the irredeemable. I have the redeemable. I have preference. I have
Common stock.
common stock. Now, to simplify this, I can first get the book value here. I can call this one my book value. So this one, our loan was how much? If you check our statement, I think I have this. Let me copy this. If I want to simplify it to make it more understandable, that is then I can copy my preference. My preference is 100, the other one is 150. This is 100. This is 150. If I want to simplify, what is the par value? What is the par value? This one does not have any par value because it's not floated. The par value is the same as the market value. Irredeemable, the par value is 100, I think. It's 1,000, sorry. This one is also 1,000. This is 100. This is it 100, I think? Yes, 100. Now, what is the market value? The market price. This one has no market price. Irredeemable was 980. This one is selling at 1040. Preference was selling at 150, I think. This one is selling at 240. So what is going to be my market value? This one, it remains the same, the bank loan. Now, for this one which are selling, what I'm doing, I will get the book value divided by the par value multiplied by the market price. Book value divided by the par value multiplied by the market price. I get the market value. I can repeat the same thing. Book value divided by the par value multiplied by the market price. So I think I can now scroll. So what I need is these ones, this value, the market values. Now, depending on what I want, but I can copy this one down. This was just like a working to get the market value, but you can do it even anywhere. So I can now copy this one. I take this. I have to copy figures, eh? Now, sometimes you may need the weight, sometimes you may not need the weight, but we can compute our weight. Sometimes they may ask to get the weight. How do I get the weights? Depending on the question that you are answering. How do I get the weight? To get the weight, I will get the value of the source. I divide it by the total market value. I repeat, I get the value of the source divided by the total market value. Value of the source divided by the total market value. The value of the source divided by the total market value. Then here I'll have the same value of the source divided by the total market value. If you add your, it must give you one, I think. If you add all your market value. Now here I recognize the cost of each source. The cost of each source. Here it will be 0.07, I think. That's what we got. Can you tell me irredeemable will go to what? If we wrote irredeemable we got
0.1.
0.1. Redeemable, we have got 0.135. Eh? Preference. Preference will go to what?
6.7%. So it is 0. What?
0.6.
Yeah.
And the common stock 0.2 what? 0.2?
218.
Now this one I can compute your wachacha. So I will just get the weight times the cost. Just to get the weight times the cost. Weight times the cost. So I can now add to get my wachacha, which is going to be, I only needed one. This is my wachacha. That is one way to do it. The other way, which is also simply not hard, I only get this if I want to use this.
Can you scroll up a little bit?
Up to
The first table. Okay.
I want to show you one more way, and then
Excuse me, can you show us how you computed the cost?
the cost is what we consider the cost of each source. The one we have been calculating.
Oh, okay.
Yes.
Excuse me, sir.
Yes, please.
Where is this per value of 1,000 coming from for irredeemable and irredeemable?
I said, if you have a market value, automatically you can know the face value, even if the question has not given you. So by having a market value of this, it means that the face value is 1,000. Because debts are sold in a denomination of 1,000 or 100.
Excuse now.
Yes, please.
Can also be applicable on preference and common stock.
No. It's only on debts.
On redeemable and irredeemable.
Yes. Those are loan stocks. So I want to copy this one, and I also copy this. Now, I want you to show you something else again, as far as this is concerned. I want to show you something again. The other way to compute the cost, I don't need to compute the weight. What I do, I get the cost times the market value. Are you getting each other? I just get the cost times the market value. Then what I get here, I just get the cost. One was giving me the answer in percentage because I had put percentage. How do I remove it? Number. Okay. Now, in this case, this is not going to be my wachacha. My wachacha will be equal to this divided by this. So that is the other way to do it. I don't know if you have got it.
Excuse me, sir.
Yes.
My internet was interrupted. I don't know how you calculated the cost.
The cost is the one you have been calculating. Remember where you started with the cost of bank loan? It is here.
Oh,
The
now I
cost
see.
of common stock is here. You get it?
Now I get you.
Okay.
Please share, remember to share even that Excel because we need to make a revision ourselves.
Okay.
Yeah.
Can you move on? I think the next part of the question, we are looking at the marginal cost. The marginal cost of capital.
Let us see, scroll up a little bit.
Up
Actually,
to
there. It's okay.
Excuse me, sir.
yes, please.
Please come back on how you calculate, we calculate the growth rate if it was not given.
Okay. I think it was here. We were given dividend of 2023 and a dividend of 2015. So we used the arithmetic model to compute the growth rate. Is it okay?
Yes, sir.
Can we move on? But members, if you want our class to run smoothly, you should pay. Because I'm seeing the list of those who have paid, others who have not paid. You are just enjoying my class without paying.
They have to pay.
Yeah, I'm only seeing a list.
We thought you already paid.
No, some have not paid. I've been given a list. There's only 17 that have paid. And
Stop.
Felix is a good guy to recover.
eh?
Felix is a good guy for recovery.
Who is the recovery manager? Director of
Felix is a good manager.
But you have some have not. Some are not paying. Okay. Okay. So next time, please give me the list. Then I don't allow those who are on the list to enter. Can we go on?
Yes.
Yes, sir.
Okay, I want to look at this marginal cost of capital. And you remember we said it is the additional cost. It's additional cost. Cost on the new sources of funds that have been raised. So if you check our information number 6, number 6 was the company is evaluating investing in a new carbon reducing equipment. This will require additional investments. Our additional investment is going to be 250, which will be raised 100 million from common stock and 150 using a mortgage loan. The cost of common stock will increase by 3%, but the bank loan is going to increase by 4%. So our additional capital, if we check our data, we have additional capital, additional equity capital is 100. If I reduce 3 zeros, and this is the amount, and the increase in cost of equity will be increase in cost of equity is 3%. Then, if you look at the additional debt, or loan is 150, and the increase in cost of debt, cost of loan is 4%. So if I can, because we are looking at the cost of addition, if I can bring this table down here, this one, if I can bring
Excuse me,
this,
sir.
yes, please.
How did you calculate those increase in the cost of equity
No,
and
I just estimated. It's in the question estimation. I don't have any calculation that I've made.
okay.
It's given.
Okay.
So it means if my bank loan was 40, increase of 150 is going to be 190. Isn't it?
Put formula, please.
Huh?
You put formula.
For bank loan, it will be 40M plus 150M. So it can move away from the thing. Let me leave it. Another which is increasing is common stock. Our common stock, and here it is increasing by 4%. It means this is going to be 0.11. Maybe I can write it here. Value of bank loan for understanding will be 150 plus the original, which was 40. New cost will be 0.07 plus 0.04, which is 0.11. Then our equity, our common stock, value will be 360 M plus 100 M, which is 460. Then the cost will be 0.218 plus 0.03. We get 24. 0.248. I think it becomes clear now. So I've changed this. This becomes this was 36 or 360. It becomes 440. This becomes this.
Excuse me.
Yes.
Where do you get 440 from?
It was 360, then you add 100.
Hey, it is 60. Okay. So what is going to be my MAA? The weighted marginal cost of capital. We are going to get 169,718 minus 116,018. 116,018, the previous one. Then I divide by 103, 200 minus 753, 200. 753, 200. I don't know what you get here.
Excuse me. Is it 753,000 or 753,200?
200. There's a 200.
Can you correct that?
So it's going to be this.
Scroll.
Let me first put in this formula minus this. I don't know if it will accept. Divide by this minus this. So there's an increase of how much as a result of so it means the marginal cost for all these sources will be around 6 point something. The additional cost. If you get this 21.5 minus 14.4, you have around do you get what we are talking about here? So that's what you are going to look. You only adjust for the additional costs. So the last part here, maybe we can look at the weaknesses.
What is that? WMCC.
Weighted marginal cost of capital.
Okay. Scroll up a little. Yes, okay. There. Scroll down.
So let's look at the weakness. Number one. So it assumes that the capital structure will remain.
The cost of capital.
Yes.
Where did you get that number 116? You are pulling from the Wachacha?
Yes.
Above Wachacha?
Yes.
Oh, okay. That is weakness of what? Of
Cost of capital.
Oh. Wachacha?
Yeah. Yeah. It remains. It assumes that the cost of the capital structure will remain unchanged.
So even the title will also weakness of weighted
Weaknesses of cost of capital.
where is the cost of capital?
When we say cost of capital, of course, we are talking about the Wachacha.
Oh.
Yes. Now, one of the weakness in the cost of capital is that we assume that the capital structure is not going to change. So if you are financing a business maybe with 100 million, composed of 50 million debt and 50 million equity, we assume that the capital structure is going to remain unchanged throughout. There's nothing you are changing in the capital structure. So that is one weakness in a capital structure. Number two, it is complicated to compute in practice. In theory, when you have the data, it's not very complicated. But in practice, it is based on a lot of assumption to compute. If you are in practice, it is based on a lot of assumptions if you are to compute the cost of capital. So it is in practice, it is very complicated to compute. Number three, it assumes that the risks of the business will remain unchanged. So we always assume that the risks are going to remain the same throughout. You're not going to change. Whether you are increasing your capital, you are doing what, the risk is going to be the same. But in practice, we know that the higher the risk, the higher the return. So that's why we are always assuming the cost is going to remain. Because of that, the cost of capital remains unchanged. But as the risk increases, the capital owners will start to demand a high return. So those are some of the weaknesses when it comes to the capital, cost of capital, and that marks the end of this part. So there are two questions I looked at. Maybe we can go through, but I think this question we have done summarizes maybe this question that we can talk about. So if you look at this, this question, this is a question of.
Let's first finish the copy.
it okay?
Excuse me.
Yes.
Sometimes in exam,
Hmm.
they ask us to explain
Hmm.
weaknesses more than 3, like 4 or 5.
More than like how many marks given? 10? It depends on the marks. But I think, yes, sometime it can be maybe, but I don't think someone can examine 10 marks on this.
Assume that they say 5. They assign 5 marks.
Yeah, maybe in that case, other 2 points.
Or maybe they ask us to explain benefit of water.
Of course, that's what we started with, the importance.
Mm.
Hmm. Let's look at this briefly, then we can go on to another part. If you look at this one, this is a question 2024, February. Maybe we can look at it. It was part C, I think, of the question. It says, Dodora Limited, one of your corporate clients asked Mutes to calculate the wachacha to be used in the project evaluation. Mutes has made such calculation before in her studies. You have the number of share, the tax rate, the market price of the share, market price, the debt. Now, if you look at this, even if someone has not given you, by looking at the price at 107, automatically the power value means is 100. Even if the question is silent about it, you have an equity beta, you have a risk-free rate. Now, down here, we have a market return. You have a convertible debt per valuation, which is this. It's a convertible debt. You have a bank loan, which is this.
Per valuation means per value.
Yeah, I think that maybe the way it was valued, I don't think it was per valuation. The per value, per value, it is this, which means valued at the 100. So the dollar share price is expected to rise at a rate of 2% per year. That's the growth. You have the growth rate. The convertible debt can be redeemed in 4 years' time at a premium of 20% of their current market value, or be converted into ordinary shares at the rate of 1 for every 1 bond. That's the conversion ratio is given. Then it required calculate the weighted average cost of capital, or wachacha, and advise the project appraisal. Now, if you look at this again, I think how many sources do we have? We have 3 sources of capital that we need here. You have a bond, you have the ordinary share, we have the bank loan, we have
a common stock.
The
we have
common stock.
we
I
have
think you have
the
three.
convertible.
Yeah, we have three sources.
Yes.
We have three sources of this. Now, if you have this, if we can maybe, I don't know whether I can make it here on this page. So as we said, our solution, we start with the cheapest, the cost of bank loan. The cost of bank loan. How do I get it? We already know the formula. It is I into 1 minus T. So do I have the data to feed my formula? That's the first important thing to look at in the question. Do I have the relevant data to feed my formula? So now, if you look at this, our bank loan is 8%. It means our I is 8%. T is given as 30%. I think this one you can, now it means I have all the relevant data that I can feed my formula. So my KBL will be 0.08 into 1 minus 0.3. And then I think we get what? 0.056, I think, which is the same as 5.6%. Are we there? Now, the next part that we need to calculate, which is a bit still simple, is the cost of preference, so cost of common stock or ordinary share, which is my KE. Now, based on this data, based on this, we are not using a dividend model. Based on the data we have, we are not using a dividend model. What we are using is CAPM. Is it okay? So if we are using CAPM, so my KE, based on the data we have, is the risk-free rate plus my beta into market return minus the risk-free rate. Then the question, do I have the data? Do I have the data to feed my formula? Risk-free rate is given, is 10.4% is given. Market return, RM, is also given. It is 16%. And beta is also given. It is an equity beta, 1.6. So what else do I need? It is a geared business. I don't need to adjust anything. It means my KE, if I am to substitute, will be equal to, I have all the necessary data, 0.1. Yes.
If it is not a geared business, what
And
do
you are
you
given
would you take again?
And you are given an equity beta. I will have to Nigeria to get an asset beta.
Oh.
But that's what we are going to discuss in our next chapter. Plus 1.6 into 0.16 minus 0.104. Our K is your calculator. %. Okay. Now what are we remaining with? The cost of convertible debt. Cost of convertible debt. You remember what we said? If you are cost of convertible debt, what we need is the IRR of this debt. You need the IRR. Now, needing an IRR, what data do we need? First, we have been given the par value. The par value or the nominal value of the debt is given as 100. Our interest, our coupon rate is 7%, meaning the interest will be equal to 7%. Are we there? Times 100 times 0.1 minus 0.3. Isn't it? And you get what? Interest. $4.9. Good. Now, what is the market price? We have it. The current market price is 107. That one we have it. The current market price of the debt is 107. Now, what else do we need? We need a redeemable value. Redeemable value, which you said is the higher of conversion value and the market value. So then what is going to be our market value? The market value is given. They said the bond is going to be redeemed at a premium of 20%. So it will be having a market value of 100 plus 20% times 100. I think which is 120. Now, then, what is our conversion value in this case? What is the conversion value? Now, if you look at our conversion value, in this case, maybe I have not talked about this, but how do I get a conversion value if there is a growth rate? my conversion value will be the price into 1 plus G power N Are you there? Times the conversion ratio. Are we there? To get the conversion value will be the current price, because in this question they are told us that the price is going to grow. If there was no growth, you just get the price times the conversion ratio. But since there is a growth, you need to recognize the growth rate in the price. Are we there? So what is going to be our conversion? We have been given P, our conversion value is going to be equal to 100, 1 plus our growth rate. I need to summarize that. 0.02. It is given in the question. Power 4. Our conversion ratio is 1 times 1. Maybe I can do that data here. Our G is.
Where do you get that from?
Okay, let me first. Our G is 2%. Our price, conversion price or exercise price. Our exercise price is 100. Our conversion ratio is 1, and N is 4. Someone is asking, where am I getting this? I think we read the question. The bond is going to be redeemed in 4 years. Are you seeing it?
Yes.
And every one bond, you will be getting 1 share. And the price is 100. It means you can convert at 100.
Now, if is it one share or one franc or one
for ordinary share at a rate of 1 for every 1 bond.
I thought it was a coupon rate.
Huh?
CR.
Every 1 bond of 100. Is it okay? That's the coupon.
Now, the formula is saying times a coupon rate.
Conversion ratio.
Oh.
Hey, because I've been using CR, sorry. Let me write it in full here, because you have been using CR as coupon rate. Conversion ratio. What do you get then with your calculator? What do you get? Members, you are delaying and time is going.
It's 108.2. 8.2.
So it means, which one are you going to take now? We are taking a market value. Seriously?
Yeah, it is better than
120.
108.
I'm going to take 120.
You are taking 120.
Yes.
So we now put in our item? Well, now you can calculate it since we have now summarized it. Period, cash flow, then the discounting factor. We are going to compute at what? At 70%. Then our present value. So we have the PO in a period 0, which is 107. Then we have our interest or coupon from period 1 to period 4. It is, we go to what? 4.9. 4.9. And our RV in a period 4, which is 120. So here is 1 plus 0.07 power minus 0. I can copy the formula. This will be power minus 4. Then here it is an annuity. 1 minus 1, plus 0.07 power minus 4 divided by 0.07. But you can, for you read your table, only that for me, I don't have access to the table. You can read this table for this. You don't need to calculate when you have the tables. Hey, almost there. Our NPV at 70% is 1 positive. So we can now get a negative. We're going to try NPV at 10%. NPV at 10%, I think.
Yeah, we have to increase the rate.
Yeah, let's try 10%. So we are changing this to 0.1. Change this.
The NPV is 2, not 1.
It is 2.
Yeah.
How come I'm adding it 2? Excel as a this is okay. This is 2. How come why is giving me 1?
It's a 2.
Yeah, there are some points rounded off in 1917 and in 1992.
Here.
Yeah.
That's what I'm getting for me in Excel. I don't know. So what is the IRR? You can use any, you can use cost of capital, you can use any as long as you are consistent. 0.07 plus 1.5. $1.145 minus becomes plus, plus 10. $0.0. B is 0.1 minus 0.07. What are you getting? Now I don't know because we are getting a different answer with my Excel. You are getting?
What do you put this the numerator in a bracket?
Just to simplify, but it has no issue. It is it? Okay.
Yeah, it's correct.
7.3. So can you now, I think if after that you can move on. If you have the source, you have the book value, you have the par value, but do we need to calculate all this? Or we have, the question is very clear. Can just get the source and the market value. Huh? Source, I think you can just make the market value. Market value. I don't think we need to. Then I need the weight. Then I need the cost. And then my wachacha. So the source I have is the bank loan. The market value is the same as the book value. Is how much? Bank loan.
Yes. Yes.
Calculate.
You can't see it properly.
That's what I want to check. The bank loan is 200 million. Isn't it?
Yes, it is.
Yes, it is.
Niba ari uko byagenze
Mr.
ukabona toto
200 million.
wongeye kuri momo yawe ukabishyura
Mr. uzabishyura.
ushaka nyine none se commitment pesa akoze avuze ko ari twebwe ejo tuzayabaha
Then you have
nta kibazo none se ibyo twese ibyo byananiye ngewe
the common stock. Ninde ari kwishyuza?
ni ukuvuga nagize ngo ngiye PS na Sandrine bagiye kudufasha none se nk'ubu mwanje umva mubwiye dutangira fiscal ya sibyo uyu munsi ni tariki 3
Reka mu myute.
twari dufite barayatwaye
Ari kwishyuza Kirizesto.
Yasabe minikofe nayo batwaye.
Reka tukaculating hano. Number of shares are given 450. Seriously? 480, sorry. Number of share and the current market price is 145. So it means I can compute my market value here. My market value here will be 480, 480 million. Is it 480 million?
Right, it is.
Times 145, like that. The figure is very big, eh? Then the convertible bond, our bond, it will be 360 million. 360 million divided by 100 times 107. Isn't it? It will be 360 million. Please check for me divided by 100 times 107. My one is on the common stock. Have I copied the right figure on common stock?
Come back on the question so that we can confirm.
Yeah, it is 480 million shares. I think it is correct. And this is the current market value. Yeah. I think the figure is very big, but it's okay. So what is the weight? This? Why my cursor is not moving? Divided by this. This? What is wrong? So here we got bank loan, we got what? 0. What? The cost. We got bank loan. Members, we are not there. 0.056. Common stock, we got what, members? Eh? 19.36. $0.0936. Is it like that? No. Like that. And this one we have got 0.073. So here I will get this time with this. So I have 19.52.
That one you got, you multiply weight times the cost.
Weight times cost.
Excuse sir.
Yes, please.
How do you get the market value of bond?
The market value of who?
Bond.
We got the par value of the bond. The valuation of the bond, they told us in this question, they said the convertible debt par valuation is 360 million, but they told us the par value for the bond is 100. So what is the market value? Getting 360 divided by 100 to get the number of bonds, then multiply by 107.
Okay.
After that, you mute. I think, I don't know if you have another question. Maybe you can go through this, but then you can...
Scroll down for the last answer. Yes.
Can we move on? Members, you are not saying a word. Can we go on?
Yes, you can proceed.
So
Yes, sir.
there is
Yes,
this
yes.
one. There is this one of 2023 April. Is it April? Yeah, April 2023. Question number 2. Maybe we can go through it, but you'll find that it is similar to what we have looked at. And I think you will be able to, you'll be in a position to do it if you follow what we have looked at. So the question reads, Mwendo Motors Company Limited is a listed company which manufactures cars, motorcycles, and bikes. It has been making a huge profit from this project in Rwanda and in the region over the past 5 years. The demand for its products has significantly increased because they produce less carbon emission than petrol using motorcycles. MMC is planning to make a new investment of 450 million to produce electric motorcycle. Through its research and development department, it has been found that MMC Limited will be profitable due to increased demand and its cost saving. The board of directors in a recent meeting proposed to issue both ordinary and preference shares and use debt to finance the new proposed investment. Mujenzi, one of the company shareholders, worried of this new investment because he thinks that the cost of financing this new investment will reduce the current share price, which would reduce his wealth. That is the first sentence. So we have extract from the financial position, the current asset, then current equity, share capital, retained earnings, long-term borrowings, 100 million, current is that. And then we have this additional information. The share capital comprised of 280 million, 280 million and 70 million of ordinary and irredeemable preference shares, respectively. So if you look at this, maybe if we look at our data summary, the ordinary share capital is going to be 2.
Can you please write the title of the question?
Question 2. Question 2. 2023 April solution. So if you check our data summary, I was trying to summarize the data to see if we can, ordinary share capital, they told us 280 million is ordinary share capital. So this is 280. If I remove 3 zeros, preference, which is irredeemable. Preference share capital
70 million.
is 70 million. If I go down, MMC Limited have a nominal value, the nominal value per share. So these ones, ordinary share, have a nominal value. So I can still make it here. Our per value here is 4, or our NV is 4. And an ex-div market price, the market price which is ex-div. And I have an ex-div. I think the language now is clear. An ex-div price, PO. Oh, hey, what is wrong? Hey. Is equal to 3.5. That is that data. And I have a dividend of 0.42 per share for 2020. Our current year is 20 what? 2021. Our current dividend, DO, or ordinary share, is what? 0.42. Preference shares, if I come here, these are even 5%. I can even put this one. This is 5%. Preference share. And have a nominal value. The per value is 3.2. The per value here is 3.2, and the ex-div price, ex-div PO, which is ex-div PO is 2.8. Is 2.8. Is 2.8. I think now we see the data, the way data is going. Then we have been told again, MMC 15% redeemable. We have a 15% redeemable share, 15% redeemable debt has a per value is 100 million. Per value is 100. Is 100. So now they want us How is it going to be redeemed? The information is silent, or it is down. That's now the challenge again in the data. I'm seeing the data as if, I don't know whether I'm the one looking at it, but as if the data is incomplete. Because the share capital, that one is okay, we can calculate it. Ordinary share have a nominal value of this, X dividend market price of this. A dividend of 0.42 per share has just been paid. So how do we compute the growth rate? There's no growth rate. The way the data is given. Is there any data that I didn't copy? Please check that question, whether there's any data that I didn't copy. Because as if that's why I'm wondering. For the cost of preference, it is okay. We can get it. Okay, let's first compute the cost of preference. Cost of preference, that one is okay. But for the redeemable, as if there's some data is missing. That's why I want you to check if there's some data I did not copy. For the redeemable, I think we get the KP, cost of preference shares. We said we get the D divided by the price. And based on this data, what is our D? Our D is equal to 5% times the current market price for preference, which is 3.2.
There is some missing information in the question. When you on the past paper, there's some information missing.
Yeah, I think that's what I was seeing. There's some information which I didn't copy.
They said that there's a table. The year.
Okay, let me go there and copy it, I think.
Yes.
I think there's there's an information I didn't copy. Okay. But I think for preference share, we can compute it.
Yes.
So we have D, which is the... Okay, let me look at the paper and copy the data. 5% times 3.2. But I think now you can compute it. You can compute this. I think it is this one. Question 2. I think, yeah, there is an information I didn't copy.
You scroll horizontally, we want to see the XDPO for
Yeah.
preference.
Let me first copy this data, which I didn't take. But how come I copied the last part and I didn't copy that? I don't know. I think that's the information I didn't copy. But I'm wondering how I copied this. Okay, so this is I think that is so you are saying I scroll where? This is the data we have that we have summarized it. Anything else? Members,
We can continue.
okay, so we can now look at I think cost of preference is also cost of ordinary shares. Cost of ordinary shares. How do we get it? Our KE, we said is equal to D1 plus G divided by my PO. So basing on the data we have, I think we have most of these variables. So the question has given us, if we check our data, we've been given a DO, which is 0.42, That's the DO. We have been given our PO, which is 3.5. Hope you are there. And if you look at G, we are not given. This one is not given, but we have been also given our DN, what we call the dividend in the initial period. Which is 0.36. That one is given. So if I check back to our table here, this is 2018, 2019, 2020, 2021, and we are in 2021. It means what will be the growth rate in this case? Because we need the growth rate. So our G will be equal to, I think, cube root.
Yes, cube root.
It will be cube root. Cube root 2. This will be 0.42 divided by 0.36, then minus 1. So what do you get as G?
%5.
Huh?
5%.
5%.
Yes.
Yes, please. Yes, Gilbert. Okay, 5.3.
That's 0.2.
Huh?
Me was
Same 5.3. I don't know which one is correct.
me was 0.2.
So 0.2, 0.3. Maybe rounded off. So once I have this, I can now get my D1. D1, which is equal to D0 into 1 plus G. So if I substitute, it will be 0.442 into 1 plus 0.053. And you get you get what?
0.44.
0.44. So you can now substitute to get your KE. So your KE will be equal to 0.44 plus 0.053 divided by our price is 4. PO is 3.5. Because it's refusing to. You've got what?
18%.
17.9.
Huh?
17.9.
17.9.
Yes.
You have rounded off.
That is it.
Okay. And of course, because even this one you are here, you cannot fail to be given marks. 17.9 and 18 are almost the same. So my issue is on cost of I don't know, redeemable, and someone did not give enough data on a redeemable. When is it redeemed? That data is not given. A redeemable debt. I don't know whether I'm only the one reading it wrongly, or you are also seeing the same information. If you see the debt is redeemable and they are not giving us, okay, the tax is given 30%. This is the par value 100. In this case, let me go back to the financial position. The current long-term borrowing is 100, so there's nothing. This is the par value of it. So there's no way you can compute the market price in that. Since we are not given the period when the debt is going to redeem it, we are going to assume that debt is not redeemable, and then we compute the basing on that. Although the question is saying the debt is going to be redeemable, but it's not giving us when are we redeeming, and we are redeeming it at what time, and we are not even given the current market price of the debt, but we are given the par value of that debt. So for me,
maybe you take away the past paper.
Whether I've left out an information?
Maybe.
Check. I'm not seeing. That's the data which was given. We are not given the market value of the debt. We are only given the par value. I'm only seeing the par value, friends. So, please, someone mute.
The question is incomplete.
For me, what I would say, because we are not given the period the debt is going to be redeemed, we are going to assume as if the debt is not redeemable. So if we assume that the debt is not redeemable, so how are you going to calculate the cost? although we are going to use the book values to calculate the cost, because we don't have the market value to calculate the cost. We are assuming that the market value of the debt is similar to the book value, because we don't have the market value. Can we assume this growth, the growth rate, but the growth rate is in the share? No, I don't think. So that is a lot of making people to our KD will be equal to I into 1 minus T then I divide by PO. But since I have no, it means my I will be equal to my coupon rate times the nominal value, which is going to be 15% times 100, and I think we shall get 15 as the I. So tax, we have it in this question. Tax is given. So yeah, the examiner put us into lot of. So we are going to have this equal to I, which is 15, into 1 minus 0.3. Then I divide by 100. Since I don't have any market value, so I'm assuming the PO is the similar. Oh. That's what my assumption is. And what do you get as the cost? $10.5? Are you getting what? 10.5? Members, I'm
How
not
did you
hearing.
get that P over 100?
That one is given in the question. That's the current nominal value. So it means, since we don't have the price, it means the nominal value is equal to the price.
We assume again.
What have we assumed again? Because
that it is irredeemable.
Yeah, and that's the first thing. Because in this case, you have a debt, but the debt has not been given the market the period of to redeem.
Maybe that is the reason on number B. They are saying discuss difficulties and uncertainty in your estimate.
So in that case, we are assuming the debt has no maturity period. It is irredeemable. It's not going to be redeemed. And we are assuming that the debt is going to have the par value and the market value are the same. I don't know if you have an issue. So what do you get as KD? KD is equal to?
You've said it's 10.55%.
10.5.
Yeah.
Yeah, I think that's it because there's no other way you can calculate it.
The examiner wanted the students just to fail.
But now you could as well calculate it in that way because there's no way else. That's why they are asking us the assumption we are making. The debt is not going to be redeemed. Although it's saying it's redeemable, but it's not going to be redeemed. So I think you can, the book value are the one you have in your statement, the market value are the one you have. I think now you can compute everything. So I don't know if you have a question on that. Any question we want to, I think tomorrow we shall, so are we agreed tomorrow we are meeting at 2 or you will be busy?
We're going to meet at 2.
We shall meet at 2.
Okay. I think tomorrow we can start another chapter.
So from tomorrow, can't we have records?
I've not yet put on, maybe if I go for Zoom, maybe I can go buy since, but I'm waiting my boss to pay me first to buy a Zoom. But, okay, I can buy a Zoom because it requires me to pay, is it $100? Because the one I had is already expired. So I have to renew and pay 100. So members, what is remaining now is to get your cost, your wachacha. Book values, you are using the values you have in your statement. Market value, you are looking at the new values. So you are going to get the book value and the market value, which I don't think it is complicated. You just follow the source, the book value. If you're using the book value, look at the book value, then calculate the weight, and then the cost, and then calculate the weighted cost. For market value, you have to get the market value of each source.
Excuse me, Director.
Yes.
Because tomorrow we can't start evening tomorrow.
No, evening, I have something also to do.
Oh, okay.
Remember, Thursday we have not been studying.
Yes.
Yeah, but I thought because it is a public holiday, but if you are busy, it's okay, you can also rest. Huh? Yeah, we can only meet for 3 hours, I think.
Okay.
I think it is good. We can meet evening.
Evening, I cannot be available.
Yeah, we get you.
Evening, I'm not available, then it means we shall have to wait until Sunday.
Can we arrange it at 3?
At 3? At 3, it means we can meet only for 2 hours because I have another class starting at 6.
Okay, it's okay. Do it the way you are planning to do.
Yes?
Yeah.
Why can't we start at 8?
8 in the morning?
Yes.
No.
No,
We will
morning.
be in the stadium.
At 2.
No.
Let's meet at 2. Let's meet in afternoon.
At 2.
Yes.
So, okay, so we have agreed at 2.
Yeah, because in the morning we'll be celebrating the liberation.
Okay.
Sure.
So, let's meet at 2 as we have agreed.
Yes.
Okay. No worries.
Okay. So, let's meet tomorrow. I'm going to share is it the Excel or the PDF? Because the Excel sometimes
Whatever you can.
formula moves out.
But if you save as a PDF, it will remain.
Yeah, it remains. Okay. So,
No,
okay, let's meet tomorrow.
to share Excel.
Huh?
Excel is good.
Excel. Okay.
You can share both.
The PDF and Excel.
Yes.
Because in Excel is where we refund the source of figures.
Okay. Okay, so have a good night, friends. We'll meet tomorrow.
Okay.
Doctor, the same to you. Thank you very much.
Thank you.
Sawa, tura.